Welcome to our discussion on this topic, that is fair value hedge. Friends, in this topic we would like to spend some time understanding the hedge effectiveness, let's say, of a contract, right? We are given some information. It's a basic loan instrument. It says that maybe a company on 1st of January 11 has issued bonds for $100,000. Okay, the duration is 2 years and the interest rate is 10% fixed. All right, now it gets into a swap where it would like to pay LIBOR plus 3%. Okay, and the reset dates are annual, so I can write it here. Let's say the interest reset date is annual, and the LIBOR in the beginning was 7% and after 1 year it is 7.5%. Okay, some very basic small instrument that we have in front of us. Essentially, when I raise this money, right, my first entry on January 1st 11 should be I will have in my account 100,000. Okay, and of course a liability of 100,000 would arise as well. All right, towards the end of the year, since I'm paying L plus 3% and my starting rate LIBOR was 7%, so essentially in this case, of course, I would say my interest expense would be 100,000 into 10%, that is 10,000. Credit, of course, bank as I'm making this payment. All right. Yep, these are the straightforward ones, so it doesn't take any point of worry. Now, the fact is that on this date, on the last day of the year, my LIBOR is reset at 7.5%. Okay, which actually means that my interest rates have gone to 10.5%, right? And I swapped from fixed to variable. That is what is the idea of course, a fair value hedge. All right, and it has gone adverse. All right, so what we are saying now is that I need to identify the value of my liability at current market rates. Is it okay? I need to assess how much is the liability value I've got at 10.5%, and my value of liability is nothing else but the present value of the cash flows. Okay, right? My original term was 2 years. I started on 1st of January 11. On 31st of December, I'm left with 1 more year. Okay, so what we are precisely saying is that my cash flows at year to end will be the interest amount of 10,000 as per the original lending arrangement, right? And principal of 100,000. So this gives me a total value of 110. Is it okay? Right? The present value of that, the present value of this would be taken as discounted by 10.5%, which means that the present value can be calculated as 110,000 divided by 1.105 to the power 1. Is it okay? So this gives me, of course, this gives me a value of 99547. Okay, and my original loan, so if I look at as per the original interest rate, my original borrowing, which is, of course, my cash flows are 110,000, my original interest rate was 1.10. This gives me, of course, 100,000 as a value, right? So essentially what I'm saying is that since the interest rate increased, my fixed liabilities value declines. Okay, interest rates have increased, my fixed liability value is 99547 as against 100,000. That this difference, for example, comes at 453. Okay, this 453 is nothing else but, of course, a profit to me. All right, which means that I would reduce the value of my bond, the original bond liability. Of course, I show it at fair value in this case, and I show a gain of 453 here. Are we comfortable on this? Right? Is it okay? Yeah. All you have done is you have taken your original borrowing 100,000, which is this value, as against the new interest rate. Your borrowings value has gone down to 99547, which means that you realize a gain of 453 here. Okay, this is, of course, towards your loan, the hedged item. What we need to assess, of course, is that what is the value of swap for me. Okay, what we are saying now, that my interest rate has increased by 0.5%. all right, that means due to swap, due to moving from a fixed to a floating rate, I land up paying 500 extra, right? Or 0.5% on 100,000 extra, which means my additional cash flows, of course, I will only pay it after 1 year. Should be 0.5% into 100,000, which come at 500. Is it okay? Right? So this is the incremental cash flow due to the swap where I'm paying extra 0.5%. I would need to take the present value of this, which is, of course, 500 divided by 1.105 again. Is that okay? Right? So when I look at this value, this would also be, of course, 453. So what I'm doing here now is I'm recognizing a loss as on this date, debit loss, credit swap, which is 453 here. All right. So what are we doing here precisely? We are all saying that we are all saying that in this scenario my liabilities value has declined, but the swap is offsetting that loss. All right. And as a result of which, I see that the change in the value of hedged item, which is my fixed rate bond, is completely offset by the change in the value of the hedging instrument, which is of course my swap here. All right. So precisely what we mean to say here is that this kind of hedging relationship is 100% effective here. Are you okay with that part first of all? Yep. So when you look into this kind of a scenario, when you look into this kind of a scenario, precisely what we are saying is that your changes in the value of the hedged item, of course there would be an opposite change in the hedging instrument. Is it really making every connect here? Right now what you need to remember here is that under a fair value hedge, every change, be it the change in the value of the hedged item or be it a change in the value of the hedging instrument, they are all reported through income statement. All right. So there may not be a big consequence of looking at any impact of this hedging relationship, whether it is effective or ineffective, right? I'm going to take some time explaining what could be an ineffective calculation that comes in here. So what I may do here is precisely I'm saying that let us say changing the information a bit and see to it, can we really make some connect out of that now. So we're just going to kind of simulate the same scenario. I'm going to just look at this entire information let's say through some other angle. So I'll just change the swap a little bit and see to it, can we deal with that part appropriately or not. Let us say that this remains exactly the same, right? But here we are saying that while the payment or payout of 10% is fixed, we are now saying that the company receives 7% and pays LIBOR now. Originally, my plan is that I'm raising funds at 10% fixed, but now against that I shall receive 7%. I would pay LIBOR. All right. It could also have been, let's say, put forth a similar way where you say that you essentially receive 10% and pay LIBOR plus 3%. All right. But now what we are saying here is, assuming my LIBOR on 1st of January 11, my LIBOR is 7%. On 1st of January 12, my LIBOR is 7.5% here. Okay. Now, the reason why we are discussing this is that my payout is essentially LIBOR. Okay. So, my discounting factor should be driven by LIBOR with respect to some changes. That's what we want to understand now, that what is that change. Okay. So, precisely, if I do my accounting yet again, we are saying on 1st of January, debit bank, credit loan, which is 100,000. Okay. On 31st of December, year 1, I'm paying, of course, 7%. Right, I receive 7% and I pay 7%, right? So essentially against 10 I'm paying again 10 only, so there's no change in that. Debit interest expense 10,000, credit bank 10,000 again. All right, now this is one side of it, of course. The other important part that comes is that the value of my loan declines. The similar way we did it before. I'm saying my outflow, future outflow is 10,000 plus 100,000. Okay. And my overall outflow is 1 or at the rate of 10.5%. That's my discount rate in total. So this is my new liability value. Okay. As against that, we are saying that minus 110,000 divided by 1.10. So this again comes to the similar value. This would be, if I just quickly do it again, although we have done it before, 110 divided by 1.105, that gives me 99547 minus 100,000. So this is of course the decline in the value. This comes at 453 approximately. So I'm saying that debit liability credit gain, which is going to my income statement, 453 here. Is it okay? Right? But essentially, okay, essentially now what I'm saying is the value of my swap. The value of my swap would be taken. I've reduced my liability book again, but now value of my swap would result into a loss essentially, and I would say create a liability and call it that swap. This particular liability is nothing else but the differential, right? My differential is 0.5% into 100,000, right? I would have paid 7%, but now I'm paying 7.5%. I'm receiving 7%, but I'm paying 7.5%, which is an increment of 0.5%. This comes to, of course, 500. Is it okay? And now we are saying that this 500 which is the overall differential as far as the incremental amount payable, the present value shall be taken at the market rate, which is 7.5%. All right. So that's the differential between looking at when you are receiving 10% and paying LIBOR plus 3%, or when you are receiving 7% and paying LIBOR. All right. So essentially what I'm saying here is that I'm bringing this, which is coming at 465. So this loss of 465 shall be recognized in my books today. Okay, right? Effectively, let's bear it in mind that I'm always going to pay 500. So this 465 is the present value of that 500. The incremental value will come. The 35 differential, 500 minus 465, would be charged over a period of time as again a P&L impact. Okay. So when I go to my next year, we are saying that on 31st of December 12, out of original liability, I would book an interest expense of 10,000. So debit interest expense of 10,000. Credit, of course, bank to the extent of 10,000. Okay. Now, while my liability, which was reduced by 453, it should be reversed. So I book this, I reverse this gain now. So debit income statement as a reversal. That's where the settlement is taking place, of course. 453. Credit liability, of course, 453. Then this reinstates my original liability at 100,000 again. All right. But also, of course, this 465 had to become 500 now. So I'm saying on the same date, 31st of December 12, debit expense, that is income statement, 500 minus 465, that is 35, and credit, of course, swap, again 35. All right. Now this swap in total becomes 500. And I settle this by saying 31st of December 12, debit swap 500, credit bank 500. All right. Now the eventual purpose here is to understand that I'm any case supposed to pay 10,500 in the next year. All right. Precisely, this 10,500 is arising on account of two things. 10,000 because of my original liability, right? 500 on account of the swap, right? The fair value of swap, which is 465 here, right? The present value of the amount payable comes in here. So I book a loss itself, and the rest would be recognized in the next year over the period of time, which is purely arising due to time value of money. Is it okay? Now, importantly, of course, I settle this loan also. So I would say 31st of December 12, debit loan, credit bank as 100,000 here. Looks okay? Yep. The final thing that we want to talk about is that if you look at the hedge effectiveness, okay, my change in the swap, the value of swap at the year end 1 was 465, okay, and the change in the value of my liability was 453, okay. So when you look at a relationship between these two numbers, this gives you a 102 point approximately 68 percentile, right? Yep. So here we are saying that to the extent of this differential, while had it been 100%, 465 to 465 or 453 to 453, we would have said that this is 100% effective, right? Perfect match. But then here you see the differential is resulting into, of course, ineffectiveness as far as your changes in the two values is concerned. Are you fine with that? Of course, a lot of variables come into picture. We talk about the fair value of such kind of derivatives. We talk about the mark to market. So those details are normally available through the financial institutions or banks. But then in a very simplified way, if I were to assess hedge effectiveness, I'm looking at the delta or the change in my hedging instrument divided by delta in hedged item, right? If it is not 100%, then we say there is some ineffectiveness as far as hedging is concerned. The ineffectiveness simply means that as management, I wanted to protect myself from the risk entirely, right? In the most perfect manner, okay? But then I could not gauge that change rightly, and that's the reason why there is an ineffectiveness in my risk management strategy. All right, so that needs to be, of course, quantified separately, and of course disclosures are required to be done for the same. Sounds okay here so far, right? So this is something that we wanted to talk about, precisely about how to look at the hedge accounting and even try to assess in a very simplified manner that what is hedge effectiveness or ineffectiveness. Looks okay so far, right? So that is from my side. Do subscribe to our channel, that is ABC Learning, and happy learning. Thank you very much. Have a good day and take care. Bye.